Hey guys, today I'm going to talk about box spreads. You might have heard of box spreads from the old Robinhood story back in 2019 of the guy who lost $50,000 plus on a $5,000 account using box spreads with Robinhood. If you're interested in that, you can search the web and there's a lot of stories on it. So I'm going to talk about box spreads, what they are, how you can use them safely, and how we can use them for zero DTE strategies to help us out if you got a small account under $25,000 where you are subject to the pattern day trading or the PDT rules. So first, a quick disclaimer that options involve a lot of risk, and only you are responsible for the trades you put on. So make sure you understand the trades you put on before you put them on. So Robinhood, you can't use box spreads; they banned them. But other brokers like Tastyworks, Thinkorswim, stuff like that, you can still use box spreads. Box spreads you should use, I recommend on cash settled and European style options. European style options are ones where you can't exercise them early. You can only exercise them at expiration. So that takes out the risk of the box spread. So cash settled European style SPX is what a lot of people use. That's what I'm going to be showing. SPX is also what I use for the zero DTE strategy, so this will play in nice. First, let's talk about what a box spread is. So I'm going to go out about a year out to the June 16th expiration, 372 days out. And what a box spread is a put spread and a call spread at the same strikes and the same expiration. So I'm going to do a 4,200 put, 4,100 put. So this is a long put spread for 38.40, and then it's also a long call spread. So I'm going to do the long, the 41, and the short, the 4,200. And this is trading for 97.30. So if you think about this trade should actually be worth $100 at expiration. That's what it'll be. You can think about that if SPX closes, let's say at 4,300, this long put spread will be worthless, and this long call spread will be worth $100. Same thing if it's down here. If it closes at 4,000, this put spread will be $100. And this call spread will be worthless. If it's right in the middle at 41.50, this put spread is going to be worth $50, and this call spread is going to be worth $50. So no matter what happens, this will always be $100 at expiration, no matter what. And the only caveat is there will be two options that'll be in the money at expiration. So you might have some assignment exercise fees depending on your broker. But point being, this is worth $100, but right now you can see it's going for 97. It's moving a little bit. 97.30 is what you start out at. So this is actually worth $100. Basically, at the end of the trade, 372 days, you will make $100 minus 97.30, which is $270. Pull up the calculator here. So $270 is what you make at the end of the year. And let's just call this a $10,000 trade. It's 97.30. So divided by 10,000. And you make 2.7% on your money. So the box spread is basically a synthetic loan. And the synthetic loan is based on the implied interest rates. So right now, the implied interest rate, 372 days out, is 2.7%. And that's actually pretty close. You can look over here. I have the interest rates. So these are the small exchange products. So the S2Y is the two-year yield, and it's at 2.735%. So you would expect 1 year to be less than that. So there's your 2.7%. So basically, if you wanted to put $10,000 into here and guarantee a 2.7% return after 372 days, you would do this long box spread. I was just curious. I looked at CD rates, and the best 1-year CD rates out there looks like it's 2% APY. And the average is 0.27%. So if you're going to go to a bank, you're not going to get anywhere near this. So people use this as a synthetic loan, like I said. You can either loan it or borrow it. And in this case, you're borrowing out that money. You're basically borrowing the 9730, and you're making 2.7% on your $10,000 investment. So box spread, you can also think of this as a fixed income strategy. And you're going to get higher than you would from, say, a prime broker or a bank. So something to look into if you're interested in the long term. So it's kind of how a box spread works. If you do 2 long spreads, you are going to make money, and it's going to hold up this $10,000 in your account for a year. If you do the opposite way, where you sell the call spread and sell the put spread, you are basically going to pay out the $270 price change. So it's $260, but it's actually should be $270 if this gets filled here. You're basically paying out $270 in interest over the year to have this $97.30 basically in cash in your account. So it's a little weird. Your buying power will go down by $270, but your cash you can use will go up by $97.30. If you're familiar with credit spreads, that's how it works. Your net liquidation amount stays the same when you put it on, but your cash value goes up. So you could use this if you wanted to buy more stock. Basically, you're buying stock on margin using this, except instead of using the interest rate that your broker would charge you, say 10%, 15%, whatever, this would be at a 2.7% rate. So you could do it this way, where you are borrowing the money and paying basically 2.7% interest on it. So that's why you would do both sides of the box spread. So that's kind of traditionally how you use it. So let's talk about zero DTE and how we could use this to our advantage. So like I said right away, no matter where SPX closes at expiration, this is always going to be $100. So one thing with zero DTE, there's no interest at play at zero DTE because it's only 1 day, and no one's going to pay you to borrow money for 1 day. It's going to be a very small amount, if any. But with commissions and stuff, no one would do it. So the key takeaway is basically this number stays locked in. So we're going to use that to our advantage. So I'm going to go back here. I did a trade today, so I'll do the 1 DTE just so it's not as confusing. So let's say we do the put side and we sell let's do the 4,100 and 4,000. Okay, so we have the short put spread. It's $100 wide, and we sold it for $3.30. Typically, what I do for my zero DTE is I do a 3x loss, max loss on the short leg. Actually, let's make it easier. Going with the 40/70 and 4,000 here. Let's say we got $1 on this short put. Normally with my zero DTE, I place a stop at 3x the net credit on the short leg only. So if I take in $1, my stop loss would be at $3. So I would lose $2 in that case. So one thing you could do, let me back up. Sorry. So when you set a stop loss, if it goes off, that counts as a day trade. For pattern day traders, you can only have 3 day trades in a 5-day rolling period. So if you have 4 or more, then you get marked as a pattern day trader, which is fine if you have over $25,000 in your account, but if you're less than 25,000, then it locks you out. Depends on the broker. Tastyworks, you get one reset in a 90-day period. Otherwise, after 90 days, your reset goes through. So basically, for Tastyworks, you can't trade for 90 days unless you have one reset, and that reset goes back in effect every 90 days. So if you have an account under 25,000, if you don't want to close this out, so you can instead buy or sell this call spread on the other side to lock in whatever P&L you're at. So if you see that this goes up to $3, you could sell this call spread immediately and lock in your loss in that case. Or if you could do it the other way, if this is worth 10 cents or whatever and you want to lock in a profit, you could sell this call spread and that would lock in the profit. So basically, when you complete this box spread, wherever your P&L is, that's what it's locked in at. The only caveat is at the end of the day, 2 of these options are going to be in the money. So you're going to have assignment exercise fees. Tastyworks is $5, so it's not a whole lot, but it can add up if you do it every single day. So with Tastyworks, the way you would do this if you wanted to take a profit is so this is a $70 spread. We sold it for $1. Let's say it got down to 10 cents. What you would do is, if I close this, you would want this to be worth $69.90. This was $69.90. There'd be 10 cents left on this other side, and that would be a 10-cent profit, or 10 cent left in extrinsic value on that side. If you were in Thinkorswim, you could make this a stop loss and put in your order. So in this case, if I wanted it, so this was $1 going up to $3 for my stop loss. Let's assume that this was 0 at the time. You would do a stop market, and you would make this at 67 because it would be, you want your $3 stop loss, and you take 70 minus 3 to get 67. So you could change that and make it a stop market order. Tastyworks doesn't have that yet. It's in the pipeline for spread stops on spreads, but it's not out yet. So that's something that you can do. If you're using Tastyworks and you want to, what you can do is you can actually right click on here, click view option and chart. And then if you do this right hand, you go to alerts. Let's see. Whoops. We go to 47 or 4070. View option. Yeah, so here you go. So you can now, what is coming up here is actually, do the wrong one, is actually this option price. So it said 119, but if I do that, you can actually make this $3, create alert. Oh, so I made it less than, so it went off. So greater than $3, clear that, create alert. So now when this option price gets to above $3, it'll alert you. So it's not exactly the same as the stop market, but it at least will alert you. So if this alert goes off, basically you would want to go in and sell your call spread, the 4070 4000 short call spread, to lock in your stop loss. So in a future video, I might actually go through this so it makes a little bit more sense. I was trying to give a broad overview of box spreads and how you can use them long term with interest rates or with 0 DTE. So hopefully this video made sense. If not, feel free to leave any questions and I can make a follow-up video. Otherwise, everyone, thanks for watching.